Did you know that an LLC can file taxes 5 different ways? And each way of an LLC filing taxes has advantages and disadvantages. That's what we're going to talk about in this video. Hello from Freedom Tax Accounting. We're an accounting firm where we have been providing quality tax and accounting services now for over 20 years. If you are new to this channel, we provide strategies for small business owners so they can achieve their financial goals. So if that's something you're interested in, please subscribe to our channel. Now, as mentioned in this video, we're going to explain the 5 different ways an LLC can file taxes and how each different way affects your taxes and result. Now, remember that this is general information. Each case is different, so we always advise that you take a consultation with your tax professional so they can evaluate your case and recommend the best LLC tax structure for your specific case. Now, if you want us to do a consultation, we are providing that as a service. This is our contact information. We are authorized to open up LLCs in any of the 50 US states. In our consultation, we will evaluate your specific case and recommend the best tax and legal structure for your venture. Okay, so this is our contact information. Call us to schedule your initial consultation. Okay, so let's go into the content. Okay, so basically, here we go. All right, so let's say that you have an LLC. All right, now your LLC can have one owner, or it can have 2 or more owners. Okay, if your LLC has one owner, the IRS will designate an automatic designation for taxes. The IRS will automatically say that this LLC of one owner, for tax purposes, it is considered a sole proprietorship and that it needs to file taxes under Form Schedule C or Schedule E if it's rental income. If your LLC has 2 or more owners, the IRS will automatically say that this LLC of multiple owners, for tax purposes, it is considered a partnership, meaning that you have to file taxes under Form 1065. Now, even though this is the automatic designation for taxes for your LLC, the good thing about the LLC is that you have the ability to elect that your LLC files taxes in a different way. For example, if you have a single member LLC that files under Schedule C or Schedule E, you can tell the IRS that you want your LLC to file taxes a different way. You can tell the IRS, one option is to tell the IRS, I want my single member LLC to be taxed as an S-Corporation. So you're going to file taxes under the Form 1120S. Another option is to tell the IRS, I want my LLC to pay taxes as a C-Corporation. So your LLC is going to file taxes under Form 1120. Now, this election you can also do when your LLC has 2 or more owners. So you can tell the IRS that you want your partnership LLC to file taxes as a corporation, S-Corporation, or as a C-Corporation as well. So this is the good thing about the LLC. You have more flexibility on how your business files taxes. So here you can see that the LLC can file taxes 1, 2, Schedule E is for rental income. So this is 1, 2, 3, 4, and 5. These are the 5 ways that an LLC can file taxes: Schedule C, Schedule E, S-Corp, C-Corp, or partnership returns. Okay, now how does each way, how are they different for tax purposes? Let's go into that. Let's start with the Schedule C. Now, the Schedule C is a form that goes inside your 1040 or your 1040 NR for non-residents. This is your personal tax return, okay? So the Schedule C is not a separate tax return. The Schedule C is a form that goes inside your personal tax, okay? Now, the Schedule C works that your business makes sales. Then during the year, you have your expenses, right? At the end of the year, you have your profit or your loss, okay? This profit or loss gets reported under your personal tax return as additional income. You do get the QBI deduction, but that's a video for the future. That's another topic. But this profit or loss gets reported on your personal tax return, and it is considered additional income. This income that you're reporting here on your personal tax return will pay your federal tax, which starts at 10%, and it can go all the way up to 37% for this tax year 2021. All these tax rates may change in the future, okay? So depending on your household income, that will determine the amount of federal tax that you pay. But you also need to pay Social Security tax or self-employment tax, which is 15.3%. So you end up paying the minimum of 25.3% in taxes. So that's the way the Schedule C works. Now, very similar is the Schedule E. The Schedule E is similar to the Schedule C, where it is a form. It's not a separate tax return. It's a form that goes inside your personal tax return. And on the Schedule E, you report your rental properties income. So if you have rental properties, real estate properties that you rent out, then that income and expenses you report not on Schedule C, you report on Schedule E. And it's very similar that you have your sales, your rental income, you have your rental expenses, and you have your rental profit or loss. Now, this rental income, profit, or loss also gets reported on your personal tax, and this rental income also pays federal tax, with the difference that you don't pay Social Security. You only pay federal tax because rental income is passive income and is not subject to Social Security taxes. So that's the way the Schedule E works. Okay? Now, the other way is, this is the third way an LLC can file taxes, and it's under a 1065 partnership return. Okay, remember that when you open up an LLC with 2 or more owners, the automatic designation for taxes is that that LLC filed taxes as a partnership under Form 1065. Okay, now you have your 1065 and you have one owner, and then you have another owner here. Okay, and once again, you can have 3, 4, 5, 6, how many owners you want. But the 1065 is a separate tax return. It's not like the Schedule C that it goes inside the owner's tax return. No, the 1065 is a separate tax return. Okay, now how does this one work? Your partnership makes sales, you have your expenses during the year. At the end of the year, you have your profit or your loss. You do not pay corporate tax. This net profit, right? This net profit or this net loss gets reported and split between the owners via a 1065 K1. So the 1065 generates a 1065 K1. So there's a K1 for each owner saying that this owner has this percentage of the net profit. For example, if let's say that this net profit is $10,000 and this owner is 50% owner and this owner is 50% owner. So this owner gets 50% of the 10,000, so he gets $5,000 reported on his tax return. And the other 50% is going to the second owner. Okay? So the net profit gets split between the owners depending on the percentage of ownership. Now, whatever gets reported on the owner's tax return from the net profit from the 1065, it's similar to the Schedule C if it's active income, meaning that this person is going to pay federal tax, which starts at 10%, and they're also going to pay Social Security, which is 15.3%, so they pay 25.3%. Okay? Same thing with this owner. Whatever gets reported under his tax return pays federal tax, which starts at 10%, and pays Social Security, which is 15.3%. Okay? So this is the way the 1065 works if it is active income. Now, if you own rental properties under an LLC that has more than one owner, that LLC also files Form 1065. Each owner will get a K1 from the net profit of their rental income, with the difference that they will not pay Social Security. Okay, this is only for passive income like rental income. So the 1065 can be used for active income, which in that case, each owner does pay Social Security. And if it's used for rental properties, then they don't pay Social Security. Okay? So that's the way the partnership works. Now remember that you can tell the IRS that you don't want your LLC to pay taxes as a sole proprietor nor 1065. One election that you can make is the fourth way, which is paying taxes as an S-Corporation under Form 1120S. That for active income, regular business income, this is the most popular tax election, where usually is where you pay the less taxes. Now, how does the S-Corporation work? The S-Corporation files Form 1120S. Okay? Now, the 1120S is a separate tax return. Okay? Now, the S-Corporation can have one owner, or it can have two or more owners. It doesn't matter. Okay? You can have an S-Corporation with one owner, and you can have an S-Corporation with two or more owners. Okay? How does the S-Corporation work? Your S-Corporation makes sales, you have your expenses, and you have your profit or your loss. If it's a single member LLC that files taxes as an S-Corp, This number gets reported under the single owner's personal tax return. Okay? If the S corporation has more than one owner, then this net profit or loss gets split depending on the percentage of ownership between all the owners. Okay? The S corporation, the 1120S, also provides the K1 form. Okay? So the 1120S does have a K1 form for each owner, and that K1 form tells the owner this is how much you need to report on your personal tax return. Okay? Now, whatever flows through the owner's tax return as an S corporation, it's similar to the 1065. Remember that under the 1065 partnership, the owner will pay federal tax that starts at 10% and pay Social Security that is 15.3% in taxes. Now, the good thing about the S corporation is that the owners do not pay the Social Security tax. The owner only pays the federal tax on the business net profit that flows into his personal tax return. So that is an automatic, you automatically save 15.3% in taxes. Okay? So that's why the S corporation is very popular, because you automatically save 15.3% in taxes. Now, this is a very popular option, but it's not the best option for everyone. So that's why you need to talk to your tax consultant or call us to schedule a consultation to see if the S corporation is the best scenario for you. Because one thing a lot of people don't know, the government does provide that tax incentive of not having to pay Social Security, but the IRS does say that the owners of the S-Corp need to pay themselves via payroll, okay? Which, as a Schedule C, you don't pay yourself in payroll. As a 1065 partnership, you don't pay yourself via payroll. But as an S-Corp, you do have to pay yourself via payroll, okay? So that means that during the year, the S corporation will have more expenses, but you save so much at the end of the year that it's worth having that extra payroll expense during the year, okay? That's the way the S corporation works. Now let's take a look at the last way an LLC can file taxes, and is via the 1120 form as a C corporation. Remember, the S corporation and the C corporation, you have to send the IRS an election form asking and telling the IRS that you want your LLC to get taxed as an S Corp or as a C Corp. How does the C Corp work? The C Corp, you file Form 1120. And once again, the 1120 is a separate tax return. A C corporation can have one owner, or it can have two or more owners, okay? So it doesn't matter. The C corporation can have one owner or two or more owners. The 1120 makes sales, has its expenses, and you have your profit or your loss. Okay? Now, this net profit or loss does not flow through the owner's tax return. That's the main difference. It does not flow to the owner's tax return. Okay? This net profit pays corporate taxes. Okay? So the corporation pays the taxes. Right now, 2021, the corporate tax is a flat 21%. Now, that may change in the future because the Biden administration is pushing to raise that to 28%. But right now, 2021 is 21%. So this net profit of the business doesn't affect the owner's personal tax return. Now, what's maybe the drawback about the C corporations? One thing is that the owners, depending on the income that the business is making, should pay themselves via payroll if they are active in the business. And the C corporation may be subject to double taxation. How? From the net profit that your business makes. At some point, you have to take yourself as an owner a dividend. Okay? This dividend will then pay taxes here and pay taxes here. So that's why the dividend pays double taxation. Okay? Now, to summarize the 5 ways an LLC can file taxes and where usually it's a good case or the most general cases where they are a good fit. The first one is as a Schedule C, which is for single member LLCs. Usually this is the best way to start. Why? Especially for businesses that have low net profit at the end of the year. Usually if your net profit is less than $40,000, the Schedule C may be a good option for you. Why? Because it's a very simple form. It's the most economical form. Usually you can take an accounting summary to your tax preparer and they can do the Schedule C for you. You don't have to be in payroll. So even though you pay higher taxes, you pay less fees and it's more economical to maintain your Schedule C LLC during the year. The second way is Schedule E, which is for rental income. Okay? The third way is the 1065 partnership return. Okay? Now, the partnership is always good if you're making passive income, like rental properties. Why? Because remember that on the 1065 partnership, each owner has to pay the 15.3% Social Security from the net profit if it's active income. But if it's passive income, you don't pay the Social Security under the 1065. So usually the 1065 is a good option for a multi-member LLC that is buying rental properties to make rental income. The fourth way is the S corporation, which is the most popular. Okay? I would say that in our clients, at least 80% of them are S corporation. The S corporation, once your LLC is bigger, starts making more sales, you can start as a Schedule C, but once your LLC starts to make over $40K in net profit a year, then you can change to the S corporation, so you take the advantage of not having to pay the 15.3% Social Security tax on your net profit. Even though you do have to pay yourself in payroll, you save so much in taxes that it's worth having that extra payroll expense during the year. Okay? And then the fifth way is the C corporation, which usually is good when the owners have high income. Usually when owners of the corporate of an LLC have higher income, it is better that for their LLC to pay taxes as a corporation. And also the C corporations are good for foreigners. Okay, so if you have a foreigner that is an owner of an LLC, usually the C Corp is a better option. Why? Because the owners will not have to pay the Social Security tax from the net profit. So foreigners don't have a Social Security, and you don't want them to pay Social Security tax for something that they see no benefit from. Okay, so basically these are the 5 ways that an LLC can pay taxes. Okay, so I hope that this video has been of a blessing to you and your business. If it has, please like it and share it with other business owners. Remember that we do provide consultations and we do open up LLCs in any 50 of the US states. This is our contact information, so you can schedule your initial consultation. Okay, so thank you for watching this video. Like, subscribe to our channel, and God bless you. Bye-bye.